Hey everyone, welcome to another homework walkthrough. This one is on stockholders' equity and a part of Chapter 13 for Cengage Financial Accounting. And we're going to go over all of these transactions, which include paying cash dividends, selling treasury stock, issuing additional shares, declaring a stock dividend, purchasing back shares, so share buybacks and treasury stock transactions there, and declaring an additional dividend. And we're going to look at each of these journal entries, posting them to the T accounts, and the impact to the statement of stockholders' equity and the balance sheet. And with that, let's get right into it. We have a company, Navco Enterprises, and they produce aeronautical navigation equipment. They have the following beginning balances: common stock, $5 stated value, which will be recorded. That means that there's no par value, but they have a stated value, and so we're going to record the stated value to the common stock account, an additional paid-in capital to the paid-in capital in excess of stated value common stock account. And they have retained earnings, and then 48,000 shares of treasury stock, which is stock that's been purchased back by the company. If we remember, there's three types of shares that a company can have, and the largest group is shares authorized. The board authorizes the sale of shares. Then the company has to issue the shares after they're authorized, and so they have 620,000 shares out of 900,000 shares authorized, and then there's shares outstanding. Shares outstanding are reduced by treasury stock, which is stock that's been purchased back by the company. And so if we imagine a circle of shares or a pie chart, shares authorized includes all the shares authorized. Shares issued will always be a smaller amount than authorized, greater than or equal, or less than or equal to, and then shares outstanding will be less than or equal to the shares issued. And the first transaction that we have is on January 15th. The company pays cash dividends of 6 cents per share on the common stock. And the dividend was properly recorded when declared on December 1st of the preceding fiscal year for $34,320. And so we know that that's the amount that we're going to pay. In 1 second here, we can go and record this. And it tells us how much of the stock that's going to be paid. But if it didn't, how we would calculate this 34,320 is by taking the 620,000 shares issued, subtract the 48,000 shares of treasury stock. We're going to assume that this was bought back before the dividend record date, and multiply it by 6 cents per share. That's the per share amount. And that's how we get the 34,320. So that's a really important to note, is that to calculate how much dividends we have to pay for the cash dividends, we don't pay dividends on treasury stock. And so we have to calculate the shares outstanding by subtracting these 620,000 minus the treasury stock of 48,000. The shares issued minus the shares bought back, that's the shares outstanding. And so we are going to record our journal entry. January 15th, we're going to debit cash dividends payable. There are 3 dates in the life of a dividend. There's the declaration date. That's the date the board of directors approves the dividend to be paid or declares the dividend. And that's usually the date of the board meeting when they vote on it. And at that point, the dividend becomes a liability to the company. And so we record debit dividends, credit cash dividends payable. Then there's the record date. Shareholders that own the stock on the record date get paid the dividend. Anyone that does not own the stock on the dividend date For example, if they sell it before the dividend date, or they buy it after the it's called the ex-dividend date or the record date. If they sell it before the record date or buy it after the record date, they don't get the dividend. Only people that own the stock on the record date get the dividend. The payment date is when the dividend is paid, and that is January 15th in this case, is when they pay the cash dividends of 6 cents per share. On March 15th, we sell all the treasury stock for $6.75 per share. And we had 48,000 shares of treasury stock multiplied by $6.75, and we get $324,000. Treasury stock is a contra equity account, and the beginning balance is $288,000 in our treasury stock T account. And so we have to credit treasury stock to reduce it. And note that treasury stock is not in this bottom part of the dividend. It's not in this bottom portion here. And so we have to use the middle part of the middle line of the journal entry for the treasury stock account. We're debiting cash for the amount that it was sold for, which is $324,000. And we credit treasury stock for $288,000 because that is the initial cost. We record sales of treasury stock at the initial cost. Then the difference is a credit to paid-in capital from sale of treasury stock because we don't record gains and losses on sales of treasury stock. It's additional capital that's been invested into the business by shareholders. So take 324 minus 288, we get $36,000 as paid-in capital from sale to treasury stock. Now we issue 200,000 shares of common stock for $8 per share. That's going to give us cash of $200,000, or 200,000 shares times $8 is $1.6 million in cash. That's our debit. We're going to credit common stock and paid-in capital in excess of stated value of common stock. If you remember, the stated value per share is $5 multiplied by 200,000 shares is $1 million in stated value. And 600,000 in paid-in capital in excess of stated value. Now we're going to declare a 3% stock dividend on common stock to be capitalized at the market price of the stock, which is $7.50 per share. And we are going to debit stock dividends for the amount of the total capitalization of the dividends. And remember that eventually in our closing entries, it's going to get closed out to retained earnings. $7.50 per share multiplied by 3% of the shares outstanding. In just 1 second here. So our shares outstanding was the initial 620,000 of shares issued plus 200,000 shares is 820,000 shares outstanding as of the stock dividend. Times 3% is 24,600 shares are issued as a part of this stock dividend. We have to multiply that by $7.50 is the market price of the stock, and we get 184,500. Then we have to credit stock dividends distributable and paid in capital in excess of the stated value of the common stock. Our stock dividends distributable isn't common stock yet. It'll turn into common stock in the next journal entry when it's issued. And so we take 184,500. We take, sorry, we take the amount of shares issued multiplied by the $5 stated value, and we get the stated value or the par value. In this case, it's no par stock, so it's stated value is a credit of $123,000. The difference is our additional paid in capital, which is $61,500. The next transaction, we actually issue the stock, and so we need to debit stock dividends distributable, which is similar to a dividends payable, except it's stock dividends. And because it's not cash, it's not payable, it's distributable. We just haven't distributed the stock yet. And so now we debit stock dividends distributable for $123,000 and common stock for $123,000. The next transaction is purchasing treasury stock. And so we have to debit treasury stock and credit cash. And the amount is 50,000 shares times $6 per share is $300,000. Next, we declare an 8-cent dividend per share on common stock. And we're going to need to debit cash dividends and credit cash dividends payable. We only pay dividends on the amount of shares outstanding. We had 620,000 shares initially, because we don't count the treasury stock that we initially purchased back. Then we have to add the 200,000 in shares that we issued, add the 24,600 in shares issued as a part of the stock dividend, subtract the 50,000 shares of treasury stock that we bought back recently, multiplied by 8 cents, and we get the dividend amount of 63,568. Then on December 31st, we have a journal entry to close the two dividend accounts to retained earnings. And dividends initially are a credit. So dividends are initially a debit. To close them out to retained earnings, we need to debit them. And our stock dividend and cash dividend amounts for the year were as follows. I took them from the journal entries above. And 184,500 plus 63,568 is 248,068. So next step that we have to do is post these transactions to the T accounts. And we're just going to go in order so that we can keep track of things. Cash dividends payable. We had a beginning balance. It looks like we did not have a beginning balance for cash dividends payable, or a T account in general for cash dividends payable. or cash. We're only doing this for the stockholders' equity accounts. Um, but we do have treasury stock as a beginning balance. And our treasury stock transaction was on March 15th. So on March 15th, we post this transaction here. Then we created the new treasury stock when we purchased it on October 30th for 300,000. And so I just take that amount directly from the journal entry. I just go to the October 30th journal entry. We debited it for 300,000 then, and the ending balance is 300,000 because we initially took away the 288,000, repurchased $300,000 of it. And the next journal entry, March 15th, we had a paid in capital of treasury stock credit. And that's the only one there. And then if we keep going down, we had common stock for $1 million. We have to post that. And that was April 13th. April 13th, we also had paid in capital in excess of stated value for common stock, 600,000. We also had, okay, we have stock dividend on June 14th. And then December 31st is when the stock dividend got closed out. Stock dividends distributable was distributable on June 14th. We actually issued the stock July 16th. And then the common stock increased July 16th. The ending value of our common stock is then 1,184,500. Let's just check our work so far here. Stock dividends distributable. Let's just take a look at that. Oh yes, the stock dividends distributable was only the 123,000. And the dates are reversed because it was a debit and a credit. See, it's important to double check the details. And also, if I had double checked the journal entry as I was putting it in, that would not have happened. That also makes our value of common stock wrong, so we need to make sure to update that there. And if we take a look at stock dividends distributable, we also had paid in capital in excess of common stock of 61,000 here. That's on the declaration date was when that was created. And for both of these, we have to properly add it up. So we had 1,123,000 plus 3,100,000 is 4,223,000. And then to calculate paid in capital, we have to add them all up. And I'm sorry, apologies for the clumsiness. I'm doing this at the same time as all of you so that I can give you an authentic experience of actually solving the problem. And I hope that you're going along with me too while solving these. And this problem is very similar to the other two, and so it should allow you to do those on your own. Now, the cash dividend was paid out on, or what was declared on December 30th, and then closed out on the 31st. So that's our journal entry there. And then retained earnings. Net income was made of $775,000. And that's going to increase retained earnings. And then our dividends decreased retained earnings. So our total retained earnings is $4,875,000 plus 775,000 minus 248,068. And with that, we have the all of our T accounts filled out and we have our ending balances. And now we have to fill out our statement of stockholders' equity. We start with our beginning balances, and that's going to be the beginning balances of all these T accounts here. So common stock, we had $3.1 million. Paid in capital was 1,240,000. Retained earnings of 4.8 million. Paid in capital from treasury stock, I believe started at 0, but I'm not sure. Yes, it started at 0. And treasury stock had a beginning balance of $288,000. So our beginning stockholders' equity total is adding all of these up. And we get $9.5 million. Then our first transaction here has paid in capital and common stock. And that's going to be issuing common stock. If you remember from our journal entry, we issued $1 million in common stock with 600,000 in paid in capital. So that's a net impact on stockholders' equity of $1.6 million. Then we had net income and cash dividends also impact our retained earnings. And our cash dividends was 63,568, and our net income was $775,000. And also note that for numbers that are subtracted, use a minus sign. And the and that also includes treasury stock. Perfect. Okay. We also have stock dividends to declare, and stock dividends impacted common stock by 123,000 and paid in capital 61,500. And retained earnings 184 with a net zero impact to total equity. The next transaction is reselling treasury stock, so sale of treasury stock, and then purchase of treasury stock is our next one here. And so in our journal entry where we sold treasury stock, we had 288,000. And then that adds to stockholders' equity, so we have it as a positive number, and paid in capital. And then the amount it was sold for is adding the two together, 324,000 net impact to equity. Purchase of treasury stock that reduced equity, $300,000, which will also be our ending balance and the net impact. Balances as of December 31st. We calculated it above in all of our T accounts. So we just take those amounts and transfer them down. And then we have to add them all up together to get our total equity once again. And there we go. That's our statement of stockholders' equity. Our paid in capital, at the top we have, so as part of our paid in capital, we have common stock, and then we have excess of issue price, and then we have from sale of treasury stock. And then we have retained earnings, and then we have our actual treasury stock, which reduces our equity at the bottom. But we have paid in capital from sale of treasury stock, paid in capital in excess of issue price, and then our actual common stock stated value. And we just take our numbers and we just transfer them down here. And once again, it's telling us to use a negative sign, and it should tell us in all these transactions what to use. And so we just have to subtotal, or you can work backwards from total equity and determine the total paid-in capital, uh, total equity before treasury stock, and then treasury stock, and then total stockholders' equity. That's all for this transaction. Thanks everybody for watching. Once again, we learned all about recording the journal entries for a number of stockholders' equity transactions, and including treasury stock, issuing new shares, stock dividends. Thank you everybody for watching, and have a great, yeah, good luck on the homework, everybody. Thank you.